November 30th, 2022. A company releases a chatbot. Within 48 hours, the internet loses its mind. By day 5, 1 million users. By month 2, 100 million users. The fastest product adoption in human history. Faster than the iPhone, faster than Instagram, faster than anything ever built. The product? ChatGPT. The company? OpenAI. And the CEO? A guy named Sam Altman, who just admitted something extraordinary. In late 2024, Altman revealed that ChatGPT loses money on every single customer, even the ones paying $200 per month for the premium version. Every single customer. And Wall Street's response to a company that loses money on every sale? They valued OpenAI at $157 billion, with a B. Let me say that again. A company that admits it loses money on every transaction is worth more than most countries' GDP. Welcome to the AI bubble, where the math doesn't add up, the economics make no sense, but the hype keeps growing. In just 24 months, we went from cool chatbot to a $7 trillion gamble that could reshape civilization or become the biggest financial disaster since 2008. Here's what makes this different from every tech bubble before it. The technology actually works. ChatGPT is genuinely impressive. AI can write code, analyze data, generate images, and hold conversations that feel almost human. But here's the problem. Working technology and profitable business are two very different things. Think about it like this. Imagine you open a restaurant. The food is incredible, Michelin star quality. People line up around the block. You're the hottest restaurant in town. But every meal costs you $50 to make, and you're charging $20. You're losing $30 on every customer. Your investors look at the line around the block and say this restaurant is worth $1 billion. That's not a business, that's a math problem, and that's AI right now. OpenAI is burning through approximately $5 billion per year. Microsoft, their biggest investor, has poured in over $13 billion. Google, Meta, Amazon, and every other tech giant are collectively spending over $200 billion on AI infrastructure in 2024 alone. And nobody, not one company, has figured out how to make AI profitable at scale. But wait, you're thinking, if it's not profitable, why is everyone investing? Because of three words that have justified every bubble in history. This time is different. Maybe it is. Maybe AI will transform everything. Maybe we're on the verge of artificial general intelligence that will create trillion-dollar industries we can't even imagine yet. Or maybe we're watching the greatest example of groupthink and fear of missing out in financial history. To understand which it is, we need to go back to the moment when the AI race went from interesting experiment to existential panic. December 2022. Inside Google's headquarters in Mountain View, California, something unprecedented happens. For 20 years, Google had dominated search. They were the internet's front door. 92% market share, $200 billion in annual revenue, the most profitable monopoly in tech history. And then, overnight, a startup with a chatbot made Google's entire business model look obsolete. The morning after ChatGPT launched, Google executives held an emergency meeting. Insiders described it as Code Red, the company's highest level of crisis response, the same level reserved for major security breaches or existential threats. Because that's exactly what this was, an existential threat. Think about how you use Google. You type a question, you get 10 blue links, you click a few. Maybe you find your answer, maybe you don't. Google makes money every time you see an ad in those results. Now, think about ChatGPT. You ask a question, you get a direct answer. No links, no ads, no clicking around. If people stop using Google Search, Google's $200 billion advertising business collapses. Simple as that. Sundar Pichai, Google CEO, reportedly told staff, "We need to move faster." This is a company that invented transformer neural networks, the technology behind ChatGPT. Google literally created the science that OpenAI used to build their product. But Google had a problem. They had something to lose. OpenAI didn't. Google couldn't just release experimental AI that might give wrong answers or say offensive things. They had a reputation, shareholders, regulatory scrutiny. They moved carefully. OpenAI moved fast and broke things. So Google scrambled. They rushed to build their own chatbot called Bard. They assembled teams, they worked around the clock. They scheduled a big public demo for February 8, 2023. The demo was a disaster. During the presentation, Bard was asked, "What new discoveries from the James Webb Space Telescope can I tell my 9-year-old about?" Bard confidently answered that the telescope took the very first pictures of a planet outside our own solar system. One problem: that's wrong, completely wrong. The first exoplanet image was taken in 2004, not by James Webb. The internet noticed immediately. Scientists fact-checked it in real time. The media pounced. And the market punished Google brutally. In one day, Google stock dropped 9%. $100 billion in market value vanished, gone, because a chatbot gave a wrong answer about astronomy. But here's the crazy part. The same investors who punished Google for an AI mistake simultaneously valued OpenAI, a company that also made mistakes, also gave wrong answers, at nearly $100 billion. The message was clear: move fast even if you break things. Don't move and die. Google wasn't the only company panicking. Microsoft saw an opportunity. They had invested $1 billion in OpenAI back in 2019 when nobody cared about AI. Now they invested another $10 billion in early 2023. Why? Because Microsoft's CEO Satya Nadella saw a chance to finally compete with Google in search. For decades, Microsoft's Bing search engine was a punchline, single-digit market share. Nobody used it. But now, with OpenAI's technology, Microsoft could integrate ChatGPT into Bing. Suddenly, Bing had something Google didn't: AI-powered answers. Nadella called it an iPhone moment for AI. He believed this was the moment everything changed. Meta's Mark Zuckerberg pivoted his entire company. He'd spent billions on the metaverse, virtual reality worlds that nobody wanted. Now he redirected everything towards AI. By mid-2024, Meta was spending over $40 billion on AI infrastructure alone. And Amazon, not wanting to be left behind, invested billions in a competing AI company called Anthropic. Every tech CEO on Earth suddenly had the same fear. What if AI is the next platform and we miss it? But there was a problem, a physical, tangible problem that no amount of money could immediately solve. There weren't enough computer chips. To understand the AI chip shortage, you need to understand one company and one man. The company? NVIDIA. The man? Jensen Huang. For most of its history, NVIDIA made graphics cards for video games. Gamers bought NVIDIA GPUs to play Call of Duty at high frame rates. That was the business. Solid, profitable, respectable, worth about $300 billion in early 2022. Then, AI happened. It turns out that the same chips that render realistic explosions in video games are also perfect for training AI models. GPUs, graphics processing units, can perform thousands of calculations simultaneously, and AI training is basically just billions of calculations. Suddenly, NVIDIA wasn't a gaming company. It was the company that controlled AI's infrastructure. By mid-2024, NVIDIA's market capitalization hit $3 trillion. $3 trillion. To put that in perspective, NVIDIA became worth more than the entire stock markets of France, Germany, and the UK combined. One company, making chips. And the man at the center of it all was Jensen Huang, NVIDIA's leather jacket-wearing CEO. Overnight, Huang became the most powerful person in tech, not because he had the best AI, because he had the chips that everyone needed to build AI. Tech CEOs started personally calling Huang to beg for chips, not their procurement teams, the CEOs themselves. Elon Musk, Mark Zuckerberg, Sam Altman, all of them needed the same thing: NVIDIA's H100 chips. And there weren't enough to go around. Here's how scarce these chips became. An H100 chip has a list price of about $25,000 to $40,000. But on gray markets and through unofficial channels, they were selling for 70,000 or more, nearly triple the official price. Companies were literally smuggling AI chips. Reports emerged of H100s being diverted to China despite US export restrictions. A black market for computer chips, like it's the 1980s and we're talking about Soviet electronics. The waiting list for official orders stretched 6 to 12 months. If you wanted to build an AI model today, you couldn't. You had to wait in line. Why the shortage? Because making these chips is insanely complicated. NVIDIA designs the chips, but they don't manufacture them. Only one company in the world can, TSMC in Taiwan. And TSMC's advanced chips require machines from a Dutch company called ASML. These machines cost $150 million each and use extreme ultraviolet lithography, technology so advanced that only ASML can build it. So you have a global supply chain with multiple single points of failure and global demand growing exponentially. NVIDIA couldn't just make more chips. The entire semiconductor industry was running at maximum capacity. This created a bizarre situation. AI companies were raising billions of dollars, but they couldn't spend it fast enough because you can't buy what doesn't exist. Imagine trying to build a house, but there's a global shortage of bricks. You have the money, you have the workers, you have the plans, but without bricks, you're just standing on an empty lot. That's AI in 2023 and 2024. Billions of dollars, massive ambitions, and not enough chips. But let's say you do get the chips. Thousands of H100s delivered to your data center. You're ready to train the next breakthrough AI model. Now you have a different problem, the economics. Let's talk about money, real numbers, because this is where the AI bubble gets really interesting. Training a frontier AI model, something like GPT-4 or Google's Gemini, costs somewhere between $100 million and $500 million. Just the training, one time. Where does that money go? Chips. You need tens of thousands of GPUs running for months. Those chips cost money to buy and money to run. Electricity. AI training consumes electricity like a small city. We're talking megawatts of power running 24/7. Some estimates suggest training GPT-4 used as much electricity as 1,000 American homes use in a year. Data centers. You can't just plug 10,000 GPUs into a wall outlet. You need specialized facilities with massive cooling systems. AI chips generate so much heat that data centers use millions of gallons of water just for cooling. Engineers. Top AI researchers command salaries of $500,000 to several million dollars annually. You need dozens of them. Add it all up, and you've spent $100 million. And you have a model. Now comes the expensive part, actually using it. Every time someone sends a message to ChatGPT, it costs OpenAI money. Here's the breakdown. Think of AI like a really smart autocomplete. You type a question, the model reads your question, processes it through billions of parameters, and generates a response word by word. Each word requires computation. Computation requires chips. Chips require electricity. Estimates vary, but each ChatGPT query costs OpenAI somewhere between $0.04 and $0.36. Let's be conservative and say $0.10 per query. Now, ChatGPT has hundreds of millions of users. Most use the free version. Some pay $20 per month for ChatGPT Plus. A small number pay $200 per month for ChatGPT Pro. Let's do the math on a paying customer. ChatGPT Plus, $20 per month. If that user makes 200 queries per month, pretty modest usage, that's $20 in cost. OpenAI breaks even. Maybe. Not counting all the overhead, customer support, infrastructure, and the fact that they also subsidize millions of free users. ChatGPT Pro, $200 per month. These power users might make thousands of queries. At $0.10 per query, a user making 2,500 queries costs $250. OpenAI loses $50 per month on their highest paying tier.
This is the admission Sam Altman made. The premium product, the one supposed to make money, loses money. And it gets worse. Microsoft integrated OpenAI's technology into their products. Microsoft 365 Copilot costs $30 per user per month. It's an AI assistant for Word, Excel, PowerPoint, and Outlook. Early reports suggest Microsoft is losing money on every Copilot subscriber. Why? Because Microsoft pays OpenAI for the API calls, and those API calls cost more than $30 per month for active users. Microsoft is betting that eventually either costs will go down or usage will drive other revenue. But right now, they're subsidizing AI adoption. Google, Meta, and Amazon are doing the same thing, pouring billions into AI infrastructure, offering AI features for free or cheap, hoping to figure out monetization later. It's a strategy that worked in the early internet. Google Search lost money for years before advertising turned into a gold mine. Amazon lost money for years before e-commerce became profitable. But there's a critical difference. Google Search and Amazon e-commerce had a clear path to profitability. More users meant more data, better results, more ads, more sales, a virtuous cycle. AI's path to profitability is unclear. Why? Because of the infrastructure problem. The more people who use AI, the more compute you need. More compute means more chips, more data centers, more electricity, more cost. Unlike software that scales cheaply, AI scales expensively. Imagine if every time Google got a new user, they had to buy a new server just for that user. That's closer to AI's economics than traditional software. Some estimates suggest that for AI to be profitable at current costs, they'd need to charge $50 to $100 per month for basic access. But at those prices, most people would quit. So you have a catch-22. Keep prices low and lose money. Raise prices and lose users. The optimistic case is that costs will plummet. Better chips, better algorithms, better efficiency. If you can cut the cost per query from $0.10 to $0.01, suddenly the math works. And maybe that happens. Technology usually gets cheaper over time. But there's no guarantee. What if we're close to the efficiency limits? What if we hit a wall? That's the question keeping AI executives up at night, and the question dividing Wall Street into two camps, the believers and the skeptics. Let me give you both sides because both have compelling arguments. The bull case, AI will change everything. The believers say we're not in a bubble. We're in the early days of the most transformative technology since electricity. Their argument goes like this. First, the technology is real and improving fast. GPT-4 is significantly better than GPT-3. The next generation will be better still. We're on an exponential improvement curve. Second, we're barely scratching the surface of applications. Right now, AI is mostly chatbots and image generators. But imagine AI that can genuinely automate knowledge work. AI that can do legal research, write code, analyze medical data, design products. If AI can increase productivity by even 10% across the economy, that's trillions of dollars in value created. Current valuations would look cheap. Third, the infrastructure spending is worth it. Yes, companies are spending $200 billion on chips and data centers, but that's building the foundation for decades of AI applications. It's like building highways in the 1950s. Expensive up front, but it unlocks economic growth for generations. Fourth, the iPhone moment is real. When the iPhone launched, nobody predicted Uber, Instagram, or that everyone would have a supercomputer in their pocket. AI might enable things we literally cannot imagine yet. Satya Nadella genuinely believes this. Sam Altman definitely believes this. His company is betting everything on artificial general intelligence arriving within years. The bulls point to productivity gains already being measured. Programmers using GitHub Copilot write code 55% faster. Customer service agents using AI assistants resolve tickets quicker. These aren't hypothetical benefits. They're happening now. And the bulls say, yes, it's expensive now, but every new technology is expensive at first. The first computers cost millions and filled entire rooms. Now everyone has one in their pocket for $500.
AI will follow the same curve. The bear case is different. The bears aren't saying AI doesn't work. They're saying it doesn't work as a business. The bear case. This is a bubble. The skeptics, led by people like AI researcher Gary Marcus and various hedge fund managers, say we've seen this movie before. Their argument: first, AI is hitting diminishing returns. GPT-4 is better than GPT-3, sure, but the improvement isn't 10x. It's maybe 30% better at massive additional cost. Each generation is getting incrementally better, not exponentially better. Second, there's no killer app. ChatGPT is impressive, but it's not changing how most people work or live. It's a tool some people use sometimes. That's not a $7 trillion revolution. Third, the economics make no sense and might never make sense. If your business model is lose money on every customer and make it up in volume, you don't have a business, you have a charity. Fourth, we've been here before. In 2000, everyone said the internet would change everything. It did, but that didn't stop the dot-com bubble from wiping out $5 trillion in market value. The technology was real, the valuations were insane. Both things were true. The skeptics point to self-driving cars. In 2016, everyone said full self-driving was 2 years away. In 2026, it's still not here. The problem turned out to be harder than anyone thought. Maybe AI is the same. They point to crypto. In 2021, Bitcoin was the future of money. NFTs were revolutionizing art. DeFi was replacing banks. 2 years later, most of those promises evaporated. They point to the metaverse. Meta spent $50 billion building virtual worlds. Nobody wanted them. The pattern repeats. Genuine technology, massive hype, unsustainable valuations, eventual crash. The bears say, show us the money. Show us the profitable AI business. Show us the company that's making more money from AI than they're spending on it. And so far, no one can. NVIDIA is profitable, yes, but NVIDIA is selling shovels during a gold rush. They're not the gold miners hoping to strike it rich. They're the ones selling tools to the miners. Much safer position. So who's right? The bulls betting on transformation or the bears betting on a bubble? The honest answer is nobody knows, and that's what makes this fascinating and terrifying. But history has some lessons, and every lesson involves the word bubble. Humans have been inflating bubbles for centuries. The pattern is always the same, only the details change. 1637, tulip mania in the Netherlands. Tulip bulbs, literal flowers, sold for the price of houses. Then overnight, the market collapsed. Fortunes vanished. 1720, the South Sea bubble in England. A company with no real business got valued at absurd levels through hype and speculation. It crashed. Isaac Newton lost a fortune and famously said, "I can calculate the motion of heavenly bodies, but not the madness of people." 1999 to 2000, the dot-com bubble. Every company with .com in its name saw its stock price 10x, regardless of revenue or profits. Pets.com spent $300 million and failed. The entire bubble wiped out $5 trillion in market value. 2008, the housing bubble. Everyone believed real estate only goes up. Banks gave mortgages to anyone with a pulse. Then it crashed, nearly taking the global financial system with it. 2021, the crypto bubble. Bitcoin hit $69,000. Everyone was going to be rich. Then it crashed to $16,000. Trillions of value evaporated. Every bubble has the same psychological elements. Element 1, a real innovation. Bubbles aren't based on nothing. Tulips genuinely were new and beautiful flowers in Europe. The internet genuinely revolutionized communication. Housing genuinely created wealth for decades. Crypto genuinely introduced blockchain technology. AI genuinely works. The innovation is real. That's what makes it convincing. Element 2, exponential growth stories. Bubbles require a narrative of unlimited growth. The internet will change everything. Housing prices always go up. Bitcoin is the future of money. AI will create artificial general intelligence. These aren't just lies. They're plausible, maybe even probable, but the timeline and magnitude get wildly exaggerated. Element 3, fear of missing out. This is the killer.
When your neighbor, your colleague, your brother-in-law is getting rich, you feel left behind. You need to get in, now, before it's too late. FOMO, fear of missing out, is the psychological fuel that drives bubbles to irrational heights. In 2000, people who missed the dot-com boom felt stupid when everyone else was making fortunes, so they bought in at the peak, then lost everything. In 2021, people who missed early crypto gains felt stupid when Bitcoin millionaires appeared overnight, so they bought in at the peak, then lost everything. Now, in 2024, tech companies that don't invest in AI feel stupid, so they're pouring in hundreds of billions of dollars. Will they lose everything? Element 4. This time is different. Every bubble has a rationalization for why historical patterns don't apply this time. The internet was truly revolutionary, so traditional valuations didn't matter. They mattered. Housing was fundamentally different because of demographics and limited land. It wasn't. Crypto was decentralized and uncorrelated to traditional markets. It wasn't. AI will create AGI and transform everything, so current losses are irrelevant. Maybe. The phrase, "this time is different," are the four most dangerous words in investing. Sometimes it is different. Usually it isn't. Element 5. Musical chairs. Here's the thing about bubbles. Smart people participate because they think they'll get out before the crash. It's like musical chairs. Everyone knows the music will stop, but while it's playing, you keep dancing. Venture capitalists investing in AI startups at crazy valuations know it might be a bubble, but they also know that if they sit out and AI is real, they'll look like idiots. So they play the game. They dance while the music plays. They plan to sell to someone else before the crash. The problem, eventually the music stops, and when it does, everyone scrambles for a chair at once. That's when markets crash. So is AI a bubble? Let's look at the checklist. Real innovation? AI genuinely works. Exponential growth story? AGI will change everything. FOMO everywhere? No tech company can afford not to invest. This time is different? AI is transformative in ways the internet wasn't. Musical chairs? Everyone's investing while planning exit strategies. It has all the hallmarks, but that doesn't guarantee it'll pop. Sometimes bubbles are justified by reality. The internet bubble popped, but the internet did change everything. The valuations were wrong in 2000, but Amazon and Google became trillion-dollar companies. So what happens next?
3 scenarios, 3 possible futures for the AI bubble. Scenario 1. AI delivers. In this future, the optimists were right. AI capabilities continue improving. GPT-5, GPT-6, and beyond actually reach artificial general intelligence, or something close enough. AI begins automating significant portions of knowledge work: legal research, medical diagnosis, software development, financial analysis. Productivity genuinely soars. Companies figure out how to make AI profitable. Costs drop through better efficiency. Prices rise as value becomes clear. The economics finally work. New applications emerge that we can't even imagine yet, like how nobody predicted smartphones would create Uber and Instagram. In this scenario, current valuations look cheap in hindsight. OpenAI at $157 billion seems like a bargain when it's worth $1 trillion. Nvidia at $3 trillion seems reasonable when it's powering a $10 trillion AI economy. The bubble wasn't a bubble. It was the early days of the most important technology in human history. This is possible. Not guaranteed, but possible. Scenario 2. Slow deflation. In this future, AI is useful but not revolutionary. It's a tool, not a transformation. ChatGPT becomes like Google Docs, helpful, widely used, but not civilization-changing. AI assistants become standard features in software, like spell check or autocorrect, useful but commoditized. The hype slowly fades. Investors realize that trillion-dollar returns aren't coming. Valuations gradually correct downward. No dramatic crash, just a slow bleed as reality sets in. Some companies fail. Most survive, but at much lower valuations. The technology sticks around, but the gold rush ends.
This is what happened with virtual reality. Everyone thought VR would revolutionize everything. It didn't. It found niche uses, gaming, training simulations, but never became the platform shift people predicted. The technology works, but it's not ubiquitous. AI could follow the same path. Genuinely useful, but not world-changing. Profitable eventually, but not at current valuations. Scenario 3. The crash. In this future, the bubble pops hard. It could happen for several reasons. Maybe AI capabilities plateau. Maybe costs never come down enough. Maybe the killer app never materializes. Maybe regulatory crackdowns limit deployment. Or maybe something simpler, a recession. During economic downturns, companies cut costs, and the first costs cut are speculative bets on unproven technologies. If a recession hits and companies need to slash budgets, suddenly those $40 billion AI infrastructure projects get canceled. Demand for NVIDIA chips collapses. AI startups can't raise funding. The whole ecosystem unravels. Stock prices crash. Billions in venture capital evaporate. Thousands of AI engineers lose their jobs. Companies that overinvested face bankruptcy. The technology doesn't disappear. Dot-com survivors like Amazon and Google show that. But many companies fail. Investors lose fortunes. The hype cycle resets. This has happened before. It could happen again. So which is it? Here's the truth. Nobody knows. Not Sam Altman, not Jensen Huang, not the smartest investors on Wall Street. We're in the middle of the story. We don't know how it ends. What we do know, the technology is real. AI can do things that seemed impossible 5 years ago. The economics are broken. No one has figured out profitable AI at scale. The investment is massive. Hundreds of billions are being bet on AI's future. The stakes are enormous. If AI works, it's transformative. If it doesn't, it's catastrophic for investors. History suggests caution. Every technology bubble in history eventually corrected. But history also shows technology can be underestimated. The internet was simultaneously overhyped in 2000 and underestimated in what it would eventually become. The question isn't whether AI is useful, it obviously is. The question is whether it's worth $7 trillion right now. And that's a question only time will answer. If you're an investor, a worker, or just someone trying to understand the world, here's what matters. Watch the economics. When companies start making more money from AI than they spend on it, the bubble has substance. Watch the applications. When AI starts replacing entire job categories or creating genuinely new industries, the transformation is real. Watch the costs. If compute costs keep falling, the math starts working. If they plateau, the bubble's in trouble. And watch for the moment when everyone realizes the emperor has no clothes, or when the emperor reveals he was wearing an invisible crown of gold all along. Because in the AI bubble, both outcomes are possible. We're betting trillions on a future nobody can predict. The technology is impressive. The hype is extraordinary. The economics are concerning. The future is unknown. Welcome to the AI bubble. Population, everyone. Exit strategy, unclear. The music is still playing. The question is, when does it stop? And when it does, will there be enough chairs for everyone? Nobody knows. And that's what makes it the most fascinating and potentially dangerous bet in modern financial history.